How effective is the Bollinger Bands trading strategy? Does it even make you money? I have tested hundreds of different trading strategies before I found which ones work the best, and I'm going to share my results with you. Welcome to this episode of Ahead of the Trade. The goal of this channel is not to sell you any paid course, it is to help you develop an extensive understanding of many different technical indicators and to show you exactly how to apply them in real trading strategies to help you discover your trading edge. Today we are going to be exploring the Bollinger Bands as a mean reversion technical indicator. We're going to explore what the Bollinger Bands actually are and how they can work for us in an effective mean reversion trading strategy. The next episode of our Bollinger Band series will be covering the Bollinger Band breakout, often referred to as the Bollinger Squeeze, which is a momentum-style strategy. Later in this video, we are going to backtest our Bollinger Band mean reversion strategy 100 times on real chart data to show you exactly how effective it really is when implemented in a trading scenario and what results you might be able to achieve from trading it yourself. The Bollinger Bands are a technical indicator that was first introduced in the early 1980s by the financial analyst John Bollinger. They are commonly used as a mean reversion technical indicator across multiple timeframes and across all different types of trading markets such as stocks and forex. Mean reversion type indicators and strategies aim to capitalize on price moving within a range where any moves to the extremes are likely to revert back to the average price of the range. Bollinger Bands are used for the purpose of generating signals to determine when price is entering oversold or overbought areas on the chart relative to its recent action and behavior. This is what the Bollinger Bands looks like on a chart. The Bollinger Bands indicator is made up of three lines plotted on the chart. This line is the simple moving average, we call it the middle line. It's most commonly a 20-period simple moving average, which means it is the average price of the last 20 candlesticks. This is called the upper band. And this is the lower band. The upper and lower bands are plotted 2 standard deviations above and below the middle line. A good way to think about the Bollinger Bands is to imagine a stretched-out rubber band. The further it is stretched out from its starting position, the more it will begin to resist and try to snap back into its original shape. The Bollinger Bands can be thought of as a rubber band around the price on a chart. If you want to read in some more detail about mean reversion, this indicator, or the following trading strategy, I've put a link in the description. The way we are going to use the Bollinger Bands to generate trading signals is to buy when we see price move from an oversold area of the chart back above the lower band into the Bollinger Bands range, like it does here. And to sell when we see price moving from an overbought area of the chart back below the upper band. If we were to follow all of these signals, taking all of the signals to buy and selling at the following sell signals, we would end up with some really excellent trading results. Such as this example, where we would buy over here and sell up here for quite a nice profit. And this one, where we would buy here at this buy signal and sell all the way up here, resulting in another great trade. However, there is a problem that we will encounter with taking all of these signals. Do you see what's gone wrong with this trade? We've bought on our buy signal here, but price has actually moved against us, and the next sell signal doesn't come until all the way down here, resulting in a huge loss. How can we avoid these kinds of trades? It's simple. We trade with the trend. Let me explain what I mean. Here, I have added a 200-period simple moving average to my chart, also known as a 200 SMA. The 200 SMA is a common tool that traders will use to determine the current trend of price. The way we are going to use it for the purpose of our trading strategy is to only take buy signals when the 200 SMA is pointing higher. If the 200 SMA is flat or pointing lower on the chart, we are not going to take the trade. There are other indicators used to determine the trend, such as the 200-period exponential moving average, 200 EMA. The important thing to remember here is to use tools to assist you in trading with the trend, and for my own style of trading I prefer the 200 SMA. For ease of backtesting, I've colored the indicator green when price is trending up and red when it is trending down. Just to recap, these are our 2 conditions that must be met before we buy and enter a trade. 1. Price must enter an oversold area of the chart, then cross back above the lower band of the Bollinger Bands. 2. The 200 SMA must be pointing higher. When these 2 conditions are met, we buy, with the confidence that we are more likely to experience a winning trade than the losing one. Let's go through some examples. This buy signal here would be a valid buy signal. We have confirmation that the trend is moving in our favor because the 200 SMA is pointing higher. Here is another valid signal to buy. The 200 SMA is pointing higher, which gives us confidence that we have a higher chance of profiting from this particular trade. This buy signal here would not be valid because even though price is in an oversold area below the lower band and it potentially could reverse and go higher, the 200 SMA is pointing lower, so we are going to stay away from this trade and wait for the next valid signal instead. Even if this ends up being a winning trade, we don't mind missing out on it because we only want to buy on the best opportunities where all of our conditions have been met and we have far greater chances of success. Now remember, just because these two entry conditions have been met doesn't mean that there is any assurance that it is going to be a winning trade, and because of this, we are going to need to use a stop loss to make sure that when we have losing trades, they are kept very small in comparison to our winners. For the purposes of making sure our losing trades don't get out of hand, we are going to position our stop loss at the lowest point of the candlestick that we receive our signal to buy from, or the lowest point of the previous candlestick, whichever is lower. So, for example, on this buy signal here, after we have confirmed that the 200 SMA is pointing higher and that this is a trade that we are going to take, we will position our stop loss right below this candlestick, as you can see on the chart. If price ends up going down and triggering our stop loss, we will only take a small loss and we will be able to move on to the next trading signal without losing a substantial portion of our account. Now that we have our buy and sell signals and we know where to place our stop losses, our Bollinger Bands mean reversion trading strategy is complete and we are ready to backtest it to see what results we get. For the purposes of this video, I am going to backtest this strategy 100 times using signals from the 15-minute time frame chart of the stock Apple, which is traded on the Nasdaq exchange. I am going to use this Excel spreadsheet to track the outcome of each trade. We are going to assume I am trading with a starting balance of $10,000 and risking 2% of my account balance on each trade. This means my position size will equal 2% of my account balance divided by my entry price minus my stop loss price. You'll be able to see my profit and loss updating throughout the backtest, and you can watch the percentage win rate as it develops. I will now begin the backtesting process. Although there are conflicting opinions on the validity of performing backtests, many of the online trading gurus who tell you that backtesting is not reliable may not be giving you the full story. While it is true that there are many misleading ways of performing backtests, which would be the subject of a video on their own, I will take a moment to explain to you how the process I am using here is both reliable and reflective of true trading results. As you can see, I am using the replay feature on the TradingView charting platform, which allows me to play back the candlestick data exactly the same way as if I was trading it in real time. Many online gurus simply look at the chart while drawing their trades over the top and call it backtesting. That is not backtesting. You cannot trade when you already know the outcome. That is why we use the replay feature to replicate a live trading scenario where we do not already know the outcome before we begin. By performing the backtest in this manner, it ensures that I am only trading based on the information and signals presented to me by the chart in the exact same way that I would be if I was trading it in real time. Another important consideration when it comes to backtesting is at exactly what time and price the trades are entered and exited. I am only making my trades at the opening price of the candlestick after a buy or sell signal has been generated. This ensures that I am buying and selling positions in the backtest at prices that are realistic when compared to live trading. Notice how I am making my trading decisions based only on two important components. Firstly, I am strictly following the rules of the strategy that we discussed previously in this video. And secondly, I am only making my trading decisions based off the information that is being presented to me by the chart. This is the only way to accurately test a trading strategy. There is no room for emotion or for making decisions on impulse. Remember, the only way to create a consistent set of trading results is to trade with a consistent set of rules and actions. Many trading strategies are specifically developed for a particular time frame or market. This strategy can be traded across any time frame and across any market of your choice. If you would like to use our free Bollinger Bands mean reversion indicator that you see in this video, please follow the link that I have included in the description. For the purposes of this video, I have only been trading the buy setup of this strategy. It is possible to also trade this setup on the sell side. The conditions for entering would be the same but in reverse. You would sell to open your position when price moves from an overbought area of the chart above the upper band back into the Bollinger Bands range and only when the 200 SMA is pointing lower. We would then exit by buying at the next buy signal. When trading any strategy, it is best practice to ensure our risk on each position, which is the distance from our entry price to our stop loss, is smaller than our potential reward, which is the distance from our entry price to our profit target. Keeping our risk smaller than our potential reward will ensure we will remain profitable, even if we are to win equally as many trades as we lose. You can see our risk-to-reward ratio develop in real time throughout the course of this backtest in the Excel file on the left side of the screen. There are many different ways to set profit targets. For this video, I have chosen to only exit my positions when price has reached my sell signal or has triggered my stop loss. Another method that you may wish to experiment with is to sell half of your position when price crosses the middle line of the Bollinger Bands and then move your stop loss to break even and wait for the second half to either trigger your stop loss for a small profit or reach the next sell signal for an even larger reward. We will further explore scaling in and out of positions in future videos. There are also many different ways to size positions when entering a trade. Many traders like to trade with the same number of shares for each trade, whereas others like to base their position size off a percentage value of their overall account. To keep my backtest results consistent, I have chosen to trade with a risk value of 2% of my overall account balance per trade. However, you may wish to experiment with different position sizing methods yourself in your own backtesting and trading. You must also understand that no trading strategy has a perfect win rate. If you look closely, you can see my win rate from the backtest so far is a little above 50%. This means that roughly equally as many of my trades so far have been winners as have resulted in losses. Taking losses is part of any trading strategy, so it is vital that you fully accept this as fact and do not let them deter you. If I was to make exceptions in my rules or trade differently, just because price was coming close to my stop loss, that would mean the results of this test would not be a truly accurate reflection of this trading strategy. Now the backtest is complete and we can analyze the results. My win rate, after 100 trades, has finished at 51%. I have made 113% profit on my initial balance and my account balance is now at $21,374. How have I made such a significant profit with nearly the same amount of wins and losses? The answer is by managing risk effectively. I have made sure, through using the effective risk management procedures that we have discussed earlier in this video, that my average winner is significantly larger, in this case, 1.4 times the size of my average losing trade. Even when my final win rate is about equal to that of a coin flip, I have managed to more than double my account size with this trading strategy. It is important to take a moment to note that without the use of my 200 SMA rule, the win rate for this strategy will drop by about 10%, and my risk-to-reward ratio will drop by a significant amount as well, which was the case in separate backtests that I have previously performed. I hope these results show you the importance of 1. Effectively managing risk while trading, and 2. Strictly following the rules we set out before the backtest, which many online gurus do not. They simply pick and choose what trade to take and formulate a story after the fact. We have taken every trade that has matched our criteria over the period of the backtest, with no exceptions. If you are interested in trying our free Bollinger Bands mean reversion trading strategy indicator for yourself, or you would like to use our Excel backtesting journal, follow the links in the description. On the next episode in the Bollinger Bands series, we will demonstrate the other half of the Bollinger Bands strategy, the Bollinger Squeeze, a momentum-style strategy that returns an even bigger profit. If you found this video to be helpful, consider giving it a thumbs up and subscribing. Make sure that you let us know in the comments what strategy you want us to test next. See you next time on Ahead of the Trade.